way as I set up. So nobody's really here just yet, but they will be soon.
Okay.
But it is live and it's being recorded. And let me get on Instagram for a second. So I can go live on Instagram. Mm, Okay. 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 We are officially on Instagram and we're live on Instagram. Or at least we should be. Let me refresh. All right, cool. All right, so I'm gonna just let everybody know that we're on. I'm gonna also share this with one group and then we can just get started. Let me go to Facebook. hmm And typically people just slowly come in. All right, excellent. Copy. Facebook. Yep, we got people on Facebook already on. That's excellent. Hey, you guys, give me just a moment. I'm just doing my usual, letting other groups know that we're on live so that so they can check out the video as well or the live as well. Okay, cool. And I'm again just giving you guys just another 60 seconds. Yeah, make sure everybody comes trickling in. All right, cool, excellent. So I'm officially posted up in our group.
Cool.
Perfect. All right, you guys. So I just want to say hello, everybody, and do my formal introduction. This is Tamaya Robles. I am a credit repair expert. I am the owner of Fix My Credit Now, 850.com. I am the host of my podcast, Coast to Coast Credit. Welcome, welcome. And as you can see today, is my new segment where it's called Ask a Mortgage Loan Officer with Sean Rogers. Many of you know who Sean Rogers is. Some do, some don't. But in the meantime, welcome. And I'm going to allow him to introduce himself. But before I go into that, real fast, just a reminder, we are not on the platform you are watching us under. We are on StreamYard. So if you want to leave a comment, please feel free. But if you want us to see exactly who you are, be sure to log into StreamYard. If you don't have StreamYard, the link is in the description. Sean's information's in the description as well. We're going to ask questions and go over all the mortgage stuff as needed. But in the meantime, Sean, the floor is yours. If you can introduce yourself for those who do not know you.
Awesome. Thank you, Tamaya. Yes, once again, my name is Sean Rogers, Senior Mortgage Loan Officer. Been in the game for going on 20 years now, well versed in everything considered able to buy a house, FHA, VA, USDA, all types of financing. If there's a loan for it, I can more than likely do it. Okay. Um, what I kind of push on and what I focus my uh, I guess my drive around would be is first time home buyers and getting people ready to buy the home and taking away a lot of the fears that a lot of us may have when it comes to home ownership, knocking down stereotypes or knocking down myths that are holding us back from buying homes. So what I want to go over with you guys today is starting this off is seeing the things that I over the few years that I've been doing this, seeing the number one, two, and three issues that are kind of holding us back from buying a home and giving you some straight talk as to how to qualify and will you qualify for a home. So the first thing I want to touch on, one of the biggest issues that we face, of course, are credit issues, right? And I've seen people that have made, good amount of money. They have a low debt load, um, but they just can't seem to pay those small little bills on time. I've seen people lose their home or not be able to qualify for a home because of one or two small missed credit card payments. Now, guys, the rule of thumb is when it comes to financing on your home, we really want to see a clean 12 months of payment history, right? So the past 12 months of your life, we're going to scrutinize and analyze that. And if we see late payments on small accounts, like I've seen TJ Maxx credit cards cause someone not to be able to buy a house, right? If we see those little small hiccups there and we cannot explain those small hiccups, that could prevent us from buying a house. And when I say can't explain it, what I mean is, oh, I just forgot to pay it, or the check was in the mail, or some run-of-the-mill excuse is what we'll call financial negligence, right? So we want to make sure, number one, that I don't know if Tamaya agrees with it or not. A lot of you may not like this, but if you happen to have small credit cards that you're paying on a monthly basis, right? These store cards, you get to the front of the line at Target or the front of the line at these consumer department stores, and they say, you want to save 15%? You say, yeah, sure, give me that 15%. And they give you a credit card, right? And you just, because you were in and out there, something else was on your mind, and then you forget about paying that credit card that next month when it's due, or you get a card and you don't use it, and it has an annual fee, hits your balance, and you don't pay the annual fee. Now you're late, right? Those things can cause issues for me on the home buying side. If you do have those small accounts, you may want to look into doing uh, automatic payments on those small cards. Because I hate to tell you that, hey, look, you didn't pay your Victoria's Secret card this month, so therefore you cannot buy a house. I hate to see that. I've done a lot over the past year, right? So if you are okay with doing an auto pay, right? I don't know how you feel about that, T, but if you're okay with doing auto pays on the cards for just the minimum amount required, just, if your balance is $1,000 and the minimum payment is $30, right? You can set up for a minimum payment just to prevent, that late payment from occurring because you simply forgot about that bill, right? Very important. Now, if there's a situation, guys, where, hey, I was in the hospital, or I got into a car accident, or, something happened that was beyond my control, then we can get around those things. But anything outside of things that are within your control, they're not really going to give you the time of day to explain it. So make sure that these small little cards, please, I don't want to see this as here, these small little cards that are holding us up from buying a home. That's the first thing I want to bring up. Okay. So if you can, once again, try to enroll those cards if you're able to do so, and some type of auto pay to where it pays on the due date, the minimum required payment. Okay. And just make sure there's money in your account, of course, to cover that, because you don't want any overdraft fees.
Can I step in for a second with that one, Sean?
Yes, please.
Okay. So I definitely agree. And as much as I love auto pay, I literally just did a video on this. I think it's going to be released tomorrow. Some of my clients are on auto pay and are still getting missed payments. And the reason why is some banks, such as my bank, unfortunately, Capital One, I can't stand them, but I've been with them for so long. I like the history that I have with them. But Friday, Saturday, Sunday, and Monday are considered a weekend. Okay. And if there's a holiday that is on a Monday, then Tuesday is considered the extended weekend, right? So
Wow.
if you have a automatic payment for the actual due date and it falls in between those days, it can be a possibility that your payment is going to be deemed late. Unfortunately, I'm dealing with a client like that now. Actually, I have another client, and he has a perfect payment history, except his mortgage keeps coming up late every month, but he's not foreclosed. Well, he's not being in foreclosure because he is paying every single month. He's paying what he owes and everything, but his automatic, because the leap year, holidays, those changes. So what I would recommend is, let's say your due date for your card is on the 15th. I would have an automatic withdrawal about 4 or 5 days prior to the 15th. So it gives you enough cushion for things like that. That's if you want to do an automatic withdrawal.
Question: have you seen them reverse those late charges or late fees or late payments when those things pop up like that?
Good question. So yes, it's all about what you say to them and who you're talking to, and you have to make sure you're saying the right thing. So what I told my client this morning was just give them a call. If you need something immediate, give them a call. Don't do the whole goodwill letter thing that's old and played out. What you can do, especially if you typically have a history of making on-time payments, call them and say, hey, make it sound urgent, extreme, and dire, and say, I don't know what happened. um, Automatic withdrawal. If you don't even want to say that, just make up something like, I had a death in the family, or somebody got ill, or something extreme, because they respond to personal extremities. Like when it's an extreme situation, they respond better than a logical situation, unfortunately. So if you say, I was on an automatic withdrawal and it didn't go through on the right day, the bank will say, well, that's not our problem. You should have paid attention, right? But if you didn't know the information that I'm telling you now at that moment, then you want to say something extreme. And usually they overturn it. And if it's not that customer service rep, then it's typically the supervisor. So yeah, they'll work with you. It just depends. You just gotta be extreme and sound urgent.
Okay, so it is possible. So in case something does go sideways, or if you're referred to me and we start going through an own application, you're surprised or taken aback by when I call out a late payment on some kind of account, you can sometimes get it reversed if it's within a certain amount of time, quickly enough.
Yes,
Okay.
you usually want to catch it as soon as possible. Like my client, his happened in February, right? So we're
Mhm.
17 days into the new month. He might be able to do something about it. So, but he has a perfect payment history with them, long-standing cut. So you have to consider that. Now, if you have a track record of missed payments, and I've been flipping those missed payments, so
Mhm.
I've changed them from late to current, and then you're late again. They actually see what it was. They see what it was before, and they're gonna be like, listen, you don't have a good history with us, and
Right.
somebody keeps flipping it. Like, no. So but yeah,
Right.
if you can't do it, send them to me and I'll do it. I'll take care of it.
Perfect. Awesome. Perfect. Okay. So yeah, so those are one of the biggest things that I face. And I always tell people too that if you are in the middle of credit repair, if you're actively seeking it, there's no point in her working on your file if you can't pay, these items on time. And also, I've noticed this too. Um, what about when someone gets a new collection account? In most cases, aren't they notified via mail? Don't they get a letter? Is that true?
Aren't they supposed to? Aren't things supposed to go a certain way and they don't?
Right?
Yeah. So
Mm,
they should, but
they
they
should.
don't. That's
Okay.
why some clients, when I do a consultation with them and I mention a collection account that they're not even aware of, or even a company they're not aware of because it's a charge off account. I'm sorry, not a charge off, a collection. They don't have any sort of notice at all. Some people are still paying the original debtor because they didn't realize that the debt was sold to a different company. So when
Mm,
I'm reading it off, like, or even you, like, you'll read stuff off to the client and you'll refer them over to me, and they'll talk to me and they'll say, yeah, Sean said, this collector was on my credit report. I don't know who they are. They weren't notified. They don't know. They were not notified at all. So they're supposed to, which actually, believe it or not, it actually helps me
hmm.
dispute for you. Okay. So one of the things is if they tell you, or me, I didn't know this existed, I was not aware, let me know. So when I fight that, I'm gonna go beyond the credit bureaus. I'm gonna go to the CFPB. I'm going to the FTC, and I'm going to say, you know what, you violated their rights under the FCRA. They didn't even know you existed. So
Hmm.
no, no, this is a violation. Take it off. And they
Okay.
usually do.
Good. Good. So you would advise them to, when I'm talking to a customer and going through a consultation with them on my side, on the financing side, make sure they check their mail. Is that a big thing to make sure we push? A lot of people like me, I don't check that mail too much. Like
Me
if it's
neither.
important, you're going to email me or it's going to come via FedEx, one or the other, right? I don't
Mhm.
use Pony Express that much,
Right.
right?
Right.
But people do still send things via mail, and we need to be cognizant of that just in case something they are playing ball correctly and they do send something to say, hey. And in that case, let's say somebody gets a letter in the mail for a new collection account. Would you have them follow instructions on the letter or have them call you first?
Repeat that one more time. If they got a collection account, would I have them do what?
Would you have them follow the instructions on the letter? Because a lot of the collection accounts, when you first get a collection, they say, hey, listen, if you pay us $100, call this number now, $100. Well, we won't report it to the credit bureau. What do you say?
I say don't listen to them people. These are the same people that's hurting you. So why would I get any sort of advice or financial guidance from the people that are hurting me? Right. So
Right.
this is what we have to be clear of. Collection and charge offs are two different things. Okay. So if Sean, you are a company, Sean LLC, and you give me a line of credit of $100. I use $50. I owe you 50, and then I ghost you. Then you close the account and you have it as a charged off account. I still owe you the debt of $50 is still with you. Now, if you don't feel like hunting me down and posting this collection on my credit report, you don't feel like doing any of that. You're like, listen, I got people that are trying to pay me. Instead of me taking a complete L, I'll sell this $50 debt to ABC Collections for 25 bucks. Then it's off my hands. I get that tax write off, so on and so forth. Then ABC Collections now owns the debt. Okay. Now, if ABC Collections, yes, they're supposed to send me a letter saying, hey, we have your account, or maybe you were supposed to warn them prior to selling, whatever. That's how it's supposed to be. Most cases, it's not the case, right? But if ABC Collections comes to me and says, you owe us now $75, right? But here's a payment arrangement and we're good. Or just give us $1, we'll be straight. Give us whatever you can. Why would I listen to you guys when my debt is paid? I don't have a contract with you. I had a contract with Sean. Once you make a payment towards any sort of debt, that is a contract. I paid you. I owed you. Even if we didn't sign a black and white written contract, we have a contract because I paid you. The moment I have any sort of agreement, payment, I don't care if I paid them 10 cents. Now I'm obligated to whatever it is they say. So no, I don't. No, you pay my debt. Thank you. Now get off my credit report because I didn't ask you to pay my debt. Yeah. Don't listen to them people.
Okay. And you have free paid off debt. That makes sense. Gotcha.
Yeah.
This is why you got to know the rules to the game, guys. A lot of nuggets here. So the second thing I want to jump on is income issues that I'm seeing across the board. Now, hey, listen, this is 2024. I know being outside is expensive, right? The dollar doesn't go as far as it used to. And the same thing applies to the housing market. So I was reading a report the other day, and they were saying that, of course, the dollar is not going as far as it used to. And there's also a housing shortage. Now, I'm not. First of all, when it comes to the income, I'll jump on the housing shortage in a second here. But when it comes to the income, what I'm noticing is I get a lot of callers, emailers, people calling me for approval amounts, and it's single people buying homes. Now, in major metropolitan areas, we're going to say Atlanta, Houston, Miami, DC, New York, Chicago, major metro areas where you're going to spend $300,000 plus for a home, right? Trying to buy a home on a single income can be difficult when you look at the average debt load of Americans. So let's take, for example, where I'm at in Houston, Texas. I have a lot of teachers that try to buy homes. These are single people, right? And they have a car payment, right? And they have maybe a student loan. A lot of them don't have student loans, but maybe they have a student loan and they're paying, minimum payments of $50, $100, $200 a month, right? And a starting teacher salary, I think here is $58,000 to $65,000, somewhere along those lines. Safe to say, in the city of Houston, you're looking at a max $225,000 purchase price, right? And that won't really get you much home here in Houston, Texas. Now, if you step outside different areas, um, and that's mainly because of the property tax rates. So what I'm pressing at is that it's easier for two people to buy a home as opposed to one, logically and obviously, right? And that part, that's asking a lot, I know, right? That's asking a whole lot because you may not have someone that can, sign with you, or you may not have a life partner, boyfriend, girlfriend, wife, husband. You may not have those things. But I keep seeing folks getting discouraged because, well, they call me and they can only afford, $200,000 or 190,000 in a city where the average purchase price is $350,000, $400,000, right? It's not going to give them much of anything. And I'm trying to figure out how to combat that, right? But that is one issue that I'm seeing out there when it comes to income. Now, a lot of our other counterparts, it's a lot of couples buying homes, mother, daughter, father, son, right? If possible, yes. If you're in a certain area, in a major metropolitan area, and home prices are, 300, 350, 325, whatever they may be, and you may be in an area with a high tax rate, like a high property taxes, like here in Houston, right? I hate to say it, but on today's money, today's interest rates, 55,000 a year, 60 grand a year is not going to cut it. Not going to cut it. We gotta show more income, which is easier said than done, right? It's not easy to show that much more income. You can't just make it out of thin air, right? But I do get a lot of applicants also that are recognizing that, and they're picking up second jobs in this economy, right? To kind of make up the difference to get the debt ratios in line, right? So, and as far as a resolution to this, I don't know what your resolution is. And I'm not saying that, hey, if you don't make 75,000, don't call me. Not at all, right? If you don't make 100 grand, don't call me. It's not what I'm saying. But I want us to be cognizant of what's out there and look at the reality of the situation. Now, there's some areas in America, right? Because when we read the news reports, they're focusing on the major metropolitan areas, right? That's what everybody's focusing on because that's where we're condensed population-wise, right? That's where everybody's at. But if you go outside those areas, that 50 grand a year is okay, right? Because, like, for example, if I just drive an hour west or hour east, my tax rate is 1.5% lower than where I'm at right now, right? Which is going to qualify me for a lot more house, right? But a lot of us want to be, where the action is, where it goes down at, right? And you got to pay to play. It is what it is. But there are a lot of areas in America still that you can pick up a home in a decent area and pay $200,000, right? Then your 18 to 20 to 25 bucks an hour is okay. It's okay on a single income. And let's say you have, a car payment or a student loan, right? Then that's okay. You don't need to make six figures to buy that house, right?
Can I interject? Can I ask you a question?
Yes.
So I hear what you're saying, and I'm speaking as if I'm a potential buyer. What would it help any if positive items were removed from my credit report? Would that help maybe my debt to income ratio? Would that assist with, me being pre-approved as opposed to just focusing on negatives?
Yes, it would. So the less I have to obligate you for, the more money can go into qualifying for the home, right? We just have to make sure that that whatever's showing, because we're going to go through, your bank statements, right, and all types of accounts. We got to make sure that, if we see other accounts on there that mirror some type of recurring payment, we're going to ask about it, right? So all in all, yes, if debts were not to appear on the credit report or they're paid off, whatever the case may be, yes, it would increase a buyer's purchase power. Most definitely. Most definitely.
And another thing I wanted to, I guess, respond to you when you're talking about the interest rates. As you know, part of the podcast is we do reactive videos.
Mhm.
Is now a good time? I wanted to share a particular clip with you where they're talking about the rates, and could you, if you need to pause it in between, like they're saying points that you agree or disagree with, if you pause and respond. But would you mind if we hear it and then you give your opinion on that?
Sure. Yeah.
Okay. All right. So I'm gonna put it up now. And yep, we should be good to go. So here, this is actually the CEO of Redfin. I know some of us live and die by Redfin and some of us hate Redfin, but he's the CEO, so I guess that means something. But I'm gonna press play, and do you have the option to pause it and stuff, play and stop?
I don't think so.
Okay, all right. So I'll periodically do it.
CEO Glenn Kelman. Glenn, welcome back. Good to see you.
Good to be here. Thanks for having me.
So we know these high mortgage rates are wreaking havoc on the housing market. They're a disaster. How big of a disaster is it right now?
Well, it's been a slow building disaster, so I don't think it feels more apocalyptic now than it did 4 months ago. The housing market is just taking a beating because.
So I am going to pause it right here. Do you agree with what he said so far?
Halfway. And I'm going to explain why. Halfway.
Okay.
Because, yes, he's right about 4 months ago, whatever the case may be. But it's what we as Americans have been accustomed to for quite some time. So from 2000 and I would say 8, right? Or even 2005, 2006 until 2023, 22, we were all used to sub 5% interest rates, right? We were all used to those rates. It was the norm, right? But these were false rates. There was something called quantitative easing being placed into effect, buying bonds, suppressing rates artificially. So we as Americans have been accustomed to having these low rates and cheap money that when something is now normal, we're not built for that. But go ahead.
Okay. All right. Thank you. Thank you for that. Okay.
Affordability is at a 4-decade low. And so at some point, we just need to catch a break from the Federal Reserve. And that doesn't seem likely to happen in 2023.
Is it having the desired effect on prices, on rents, given it's also coming up against this backdrop of super low inventories?
That is the problem. So it has certainly depressed employment in the real estate sector, but it hasn't hurt prices. Prices keep going up. Usually in a downturn like 2008, people don't want to sell, but they have to sell because foreclosure is imminent. In this case.
Okay. I'm sorry. I wanted to pause this. I may not know mortgage. Okay. But my clients are renters. Either they're renters and they're trying to own, or they're trying to sell their house and some are forced to rent for whatever reason.
Mm-hmm.
I personally do not agree that they're saying that the rent growth is still sluggish. I personally don't agree with that because, correct me if I'm wrong, but due to how the market has been, people and not having the right income, so on and so forth, people are running to and being forced to rent. Problem is, I don't think it's slowing down because people aren't trying to rent. It's that ever since the pandemic happened, everybody was getting approved. Like you were saying, the interest rates were better then because, hey, I bought my first house from you guys, from you personally. During the pandemic, I had an amazing interest rate from you, right? After that, the renting game has changed, and now they treat rentals like they would owning a house. So, do you agree with the fact that they're saying rent growth? And I know they didn't touch up on it yet, but rent growth is still sluggish. Like, do you? I don't trust the news, so that's why I'm like,
right, sluggish. I don't think I would call it sluggish. Now, personally, I haven't been. I don't. One thing I don't do is keep up with the rental market. Right, I don't keep up with. But what I do know, when I'm taking applications, I do see the amount of rents people are paying in certain areas. Right, I do see that, and landlords and investors are keen to approval rates, right? They know that affordability is at a low, depending upon where you're at, right? They know that people aren't buying homes as they used to buy homes, right? Like during the pandemic, when you could qualify at a 2.5%, 3% interest rate all day long. And that would get you, somebody making 25, 30 an hour into a $500,000 house, right? Because rates were so low, the cost of money was so cheap. But now at this point, so what's happening now, and this is my opinion, my humble opinion, what's happening now is that the investors, landlords are now noticing that, hey, look, inventory is low. Homeowners aren't selling because they don't want to get rid of their 2% interest rate, right? They're not giving up the inventory. So it's not turning over like it used to turn over, right? Because they don't want to, for them to sell their house and get another house, they're going to have, going to pay more for the same house, for a different house, number one, right? Then number two, the rate's going to be higher. So they're like, look, I've got all this equity and cheap money here. I'm going to stay here. And the newly married young couple can't buy this house because, the ones that's been there for a while won't sell it. And the investors know this, right? They know that inventory is low. Home starts are also low, right? Remember, there was a period of time remember the crash in 2008, the Great Recession, all that happened,
Yes.
right? Right. So every year there are a certain number of new homes being built across the nation, right? New construction starts, right? And from 2000 and I think 10 to 2015 or 13, they didn't really build a lot of new homes because there were so many subdivisions that were abandoned or weren't finished or weren't even started, and vacant homes because of the foreclosure crisis. Right? It was so much of that, right? So being that we're 5 to 6 years behind in inventory, new home starts, these investors know that, hey, look, we have so many more people coming on the market to buy or be homeowners. Let's buy up all these properties, stabilize rent or increase it, I should say. But I wouldn't say rents have been sluggish. I would say they're going to be steadily going up until housing starts are under control. Until that happens. Now, when that's going to happen, not sure. It's going to take years to catch up with the amount of new home buyers coming on the market. People turning 18, people graduating from college. When every year more and more home buyers come on the market, and when that happens, there's more and more and more demand for living space, but supply is not meeting the demand. That's why home prices. If we sit here and say, hey, let's wait until rates come down. They wait for a while, right? In the same breath, you wait for home prices to come down. I don't see that happen either because the demand is too strong right now. It's still relatively strong because there's not a lot of it going out there. But as far as rents are concerned, yes, I wouldn't say rent growth is sluggish. Maybe we can say that they're being nice and not increasing it too fast, right?
Okay. Yeah.
But it is going up.
Okay. All right.
We have had a soft landing. The rest of the economy is doing well. People are not in dire economic straits. And with the 3% mortgage, there's no way they're going to put that house on the market. So we've had a downturn in sales volume, but an upturn in prices. And that means that the sales volume crimp is just going to last a long, long time.
Yeah, we've had some in the realty business suggest that ongoing demographic trends, marriages, having kids, going to college, even dying, means that the industry will churn through some of these rate levels, which of course we coexisted with a couple decades ago. I wonder if you think that's too Goldilocks.
No, I mean, if you look at the number of existing home sales in the United States, it goes between 4 and 6 million. During the pandemic, it actually went to a 6.5 million annualized rate, nearly 7, but it's never gone below 4 since we've been tracking it. And the population is about 10% larger than the last time we hit that low, which was in 2008. So we are now at the most basic level of Maslow's hierarchy, where shelter is a human need. The only people who are moving are the ones who absolutely have to. And there are people who are relocating because they're being called back to work, or they get a divorce, or there's a death in the family. So those are the only reasons that people are moving. I wouldn't call that a Goldilocks scenario. I would call that rock bottom. But that's where we are right now. And the only relief is that it can't go much lower. We haven't seen 3.7 million homes sold across the United States since we've been tracking the number. 4 is about as low as it can go.
So then, Glenn, how are you thinking about and planning your business around 2024? Is it a recovery year for real estate? Are you making moves in anticipation around hiring agents, or more downbeat?
You remember when Rambo is asked, Rambo, how will you live? And he says, day by day. That's how we're planning this business.
Okay.
I'm sorry. Do you agree so far? Like, what are your thoughts? Do you agree?
Yeah. So being that this video was shot in 23 and we're in 24 now, it is day by day. It's very day by day. And he's right. He's right when he says, when you look at things of human beings in America, buying and selling homes and moving on with their life, having children, retiring, dying, right? It's a massive numbers game. So life goes on. People will still continue to do what they have to do in spite of rates being high. It's not going to come to a complete stop. It's just not as prevalent as we used to see it in the years from 2015 to 2022, when money was plentiful and cheap, right? So there'll still be what he's saying, what he's saying as far as, action, right? Turnover, right? It'll still be there. Just it's not as prevalent as what we were used to seeing for the past 24 to 36 months. Because life, like I said, life goes on. Things happen. And as we increase, we're going to keep increasing in population growth every single year. It's going to go up, right? So the need's going to go up. The demand will always be there. The demand will always be there, which is good for our business, right? But it would still keep increasing home prices, I believe.
Mm-hmm. Okay.
You can't look 3, 6, 9 months out. What we face right now is 7.5% mortgages, 4 million annualized home sales rate. We're living in the now. And if things get better, that'll all be upside in the business.
How is your business dealing with the changing rate environment? Can you be profitable? Can you make money in a down market like this?
We can. We just have to reduce our costs. And so what we've done is cut non-core businesses, laid off some people, which I still feel ashamed about, but it's put us in a position where as we take market share, we can build a profitable business. But there's no free lunch here. We have to take someone else's lunch to be able to grow, because we are in a shrinking market and we feel poised to take significant share over the next 6 to 9 months.
First off, if you haven't
pretty cool. So I found it pretty interesting how his whole tone changed when she asked that last question. That was funny. So we're different. Obviously, we're entrepreneurs here. And so our people come either via referrals or direct business. So, and that's Redfin. So we're not Redfin. You know what I'm saying? We're not affiliated with Redfin. So anybody that has a concern about that, I mean, we're entrepreneurs, so that's not an issue here. Our goal is to get you into a house as quickly as possible, regardless of the market. As long as there's human beings on this planet, you're going to need a place to live and you're going to need to buy. So that's my thought. Do you have any other additional thoughts on what we just saw?
Yeah, just like you said, incessant human need. Gotta have shelter. Gotta have a place to stay. People are going to reproduce and repopulate, right? Everybody can't live in a 1-bedroom apartment. There's going to be need for housing, right? That's not going to go away. The human need for housing or shelter. What is it? As people think that. Not trying to sound political, but it's a basic human right.
Yes.
Yeah, it is. But in the same breath, we're in a capitalistic society, so people are going to profit off that, right? So as long as there's a need for shelter over our heads as humans, the housing market is going to stay, I think, strong and healthy. Well, I wouldn't call it healthy, but strong, and demand's going to be there. So I kind of agree with them on that regard.
If you're okay with it, I kind of wanted to give people, and I meant to do this earlier on, but I wanted to give the audience a little bit of a backstory about our history and how we connected. And just so I like to let my audience know, just because I'm a credit repair expert today doesn't mean I always had that mentality before. I was going through the same things. I mean, and excuse my voice cracking, there's something going on with my speech if y'all haven't figured that out. But I kind of wanted to, and the reason why this is important to me is because there's people watching that don't know you and they need to know you, right? And I say that not just because I respect what you do, but what you have done for me. So I'm going to keep my portion of it as brief as possible. And if you could just, if you remember the experience with me, right? If you can share that with people, and hopefully that will encourage and inspire others. So real quick, you guys, I have talked about this multiple times on my podcast. And if you haven't checked out the podcast, it's on YouTube, just check it out, whatever. But in a nutshell, I was a credit repair expert. I was a couple years in my business, but I'm one of those people, because I'm a credit repair expert, I test my credit so it can go up and down, and I know how to get everything off my credit, fix it, do whatever I need to do. But I was paying like $1,700 a month in rent for this nice house that wasn't mine, and the guy wanted to go up to $2,400. Did I have the money? Yes, I did. But why? Right? Like, why? Right? So anyway, I was told, it was highly suggested that I go buy and I wouldn't pay so much. So I'm like, all right, cool. I went through so many lenders. They saw my credit, and the final person was like, you need to file for bankruptcy. I'm like, well, I'm a credit person. Like, no, why would I do that? So whatever, I wound up connecting to this amazing woman named Melissa Gainey, and I do believe she's on, so shout out to her. And I think she connected me to you. And she was like, listen, he's great. Give him your information, and then they'll tell you what you need to do. So you guys definitely did that. You looked at my credit. I think I had 2 repossessions, I think, that were open. I think that's what was killing me the most. I had 2 repossessions that were open. And this is super important for those that are trying to purchase, because let me tell you guys, it's been, I don't know how many years. One of those repos is still actually on my credit report to this day. I just gave up trying to get it off. Like, they're just being goofy at this point. You know what I'm saying?
Right.
Like, they're just being goofy. But I was told, you know what? You got these 2. Your income is great. I hated my job, by the way. I hated my
Remember
job.
that? Yeah.
Deep rooted.
Right.
I
Right.
hate it. I was a workers' comp adjuster for 14 years, and I just hate it. But I was amazing at what I did. But it just kills your soul, right? But the money was amazing. So Sean basically said, you need to clean up your credit a little bit, but what's killing you the most are these open repossessions. I forgot how much it was, several thousand. And he said, whatever you do, do not leave your job. And I was like, ooh. I could do everything else but that. You know what I'm saying? So anyway, I said, and then I was told he brushed me off. He's like, all right, cool. I'll see you in a couple months. I was like, a couple months. So literally, I think it was like 30, maybe 45-ish days. I came back. I got my collections off. I had one repo was removed. The other one was closed, and I got approved because my score went up and I got approved. You guys approved me. So when Sean ran the numbers, he said, okay, I can approve you for up to 400,000. I was like, cool, but I didn't know anything about anything. I was like, 400,000, like, excellent, right? Let me go get a mansion. You know what I'm saying? I'm telling y'all, I was ignorant. And And then you said to me, I'll never forget, if that's not enough, we can go up to 500,000. I'm like, what? What? I didn't know anything about mortgage rates or anything. I just heard 500,000. But no, realistically, y'all, everybody told me no. I was told to file for bankruptcy. If I would have filed for bankruptcy and I didn't know what I know now, if it wasn't for Sean, I would have not had my first home. I had no problems with Sean. Sean is straightforward to the point. He answers your questions. He gives you an assignment. He gives you a checklist on what you need to do. It's very easy to understand. When people just brush me off like, no, no, no. And it's no, why? Like, why are you telling me no? I tried my best to leave that job. I was like, listen, I'm going to just let them fire me so I can get unemployment. Because as a credit repair expert, I'm always trying to find the loopholes. But Sean was like, Tamaya, if you don't, do I need to come down there? You know what I'm saying? I was like, I hate my job. Like, don't worry. I said, my income is so high, my unemployment is going to be top tier. But then he was like, but you make more than unemployment. Like, I'm like, right, cool. Right. He said, but the day after you close, if you want to quit, do your thing. And that's exactly what I did. Like I got the house, I closed, and I stepped out on the job, but I had a brand new house and I went full time. But I just wanted to let you guys know that is my experience with Sean. Now, moving forward, I send my clients to Sean. Sean, there's been a lot of changes. You know, we all grow as entrepreneurs, our businesses change and fluctuate and things like that. So, Sean, if you could take a moment, if you want to comment on the story, just let me know. But also let people know what makes you different, you know, I guess, than others, how you can help, how you've helped me, so on and so forth, what states you cover, things like that.
Right. Yeah. Thank you, T. Thank you. Yeah. Yeah. When we first linked up with Tamaya, yeah, it was interesting to say the least. As far as when I looked at the file, I was like, why do people tell her, you know, she should file bankruptcy or she should do this? Because I know things that, you know, personally seeing loans over the years that these things can be corrected. You know, we don't need to do open heart surgery. We just need to do a little Band-Aid and we're good. Right. So that's the main thing about a lot of loan officers. They don't look at the details and notice that, hey, these things can be fixed or rectified before we start cracking open her chest. Right. Let's fix the small problems to get us, you know, over the big humps there. And during the process, yes, we had some issues that we got resolved. It was a little stressful at times, but Tamaya hung in there for us and we got it closed. And I was so happy that she was able to buy her home, and it changed a lot for her. Guys, you got to recognize that when you own an asset, it opens up a lot of doors. A lot of us think that we can't buy a house, right? There's been situations to whereas, you know, they come to me like, hey, you know what, I want to buy a home, but I don't think I can do it. And I ask why, and they're like, I just don't think I can. So, all right, let's see what we got, right? Let's just take a peek, take a look-see, right? And beyond them buying the home, what it does for them, it gives them a sense of confidence and achievement. If I can buy a house, I can do anything. So I do follow some of my clients over the years, and I see them as they grow, right? A lot of them have gone and opened their own businesses. They went back to school and got their degrees. And it seems like it was a stepping stone for a huge hurdle. And they say, look, if I can do this, if I can buy this house, I can do whatever, right? So what I would say is also, don't be afraid to try, right? I'm not going to embarrass you or make you feel bad for calling me or demean you or belittle you, right? But I'm straight up. I'm not gonna sit here and call you out your name for having low credit or low income or whatever the case may be, right? I tell you what's going on so you know how to fix and resolve the situation at hand, right? And don't lead you down a path of not being able to do anything. But yeah, with Tamaya's situation, her buying that house, it allowed I saw Tamaya blossom and grow after that a lot more, right? As far as her business is concerned, she was able to focus more of her energy now that she had her main need being taken care of, which is her housing, her shelter, right? Now she can focus on other items in her life. And she's done that and more, right? So buying a house is more than just giving yourself a roof over your head. I would say that. I would say that it's a stepping stone to greater things that you can do as long as you just at least take the first step and try. Okay. Now about myself. So just to recap, guys, once again, I'm doing this for a very long time, right? And I've seen everything under the sun. There's nothing that's going to surprise me. Nothing at all, because I've seen it twice. Okay. So if you come to me and tell me your story, your situation, right? I've heard it. Already heard it. Right. So there's no point in you being afraid to talk to me or tell me what the situation is or tell me all the juicy details. Because the more details I know, the better I can serve you. I act as like a go-between between you and the lender, right? I filter out all the crap and I present to the lender and the underwriter all the good stuff about you, right? They don't see the bad stuff back here, right? I hide and mask as much as I possibly can for your approval, right? And what a lot of people love about me and how I operate is the fact that I tell them the good, the bad, and the ugly, and how to fix the bad and the ugly, right? When I talk to customers, just like Tamaya said, everybody turned her down or they declined her or told her to get out of the way or shoo or whatever. They just need to have a quick 5-minute conversation with her to clear some things up. And next thing you know, she has a house, right? The main thing I think is patience. Patience. All right. A lot of loan officers don't have the patience nor the experience sometimes to deal with certain situations because they haven't seen it before. And sometimes a lot of us, I hate to say it, I hate to say this, but a lot of loan officers are in it for the money. And we all have to eat and survive, right? I get that, I understand it, right? And it's totally okay, right? But at the end of the day, it starts to become, the money starts not to be relevant to a certain extent, right? So people like to work with the low-hanging fruit, right? The people that have 800 credit scores and have 30% down and just, anybody can do that, right? My 10-year-old daughter could do that loan, no problem, right? But what I like to do is some of the more different scenarios. Now, it is more difficult, yes, and a little more time-consuming, yes, but all intents and purposes, it's more fulfilling to me at the end of the day, right? Now, also, I am licensed for now in Texas, Alabama, Georgia, South Carolina, Virginia, Florida. I should have California by early next week, hopefully Monday, Tuesday. I should have California active. The next states should be this week, should be Maryland and Mississippi for activation. So hopefully before, I would say June the 1st, I should be licensed in about, I would just want to say about 40 to 42 states across the nation. So there'll be some states I won't touch. But for the most part, it should be most states. Like I won't do much in Wyoming, South Dakota, not much going on there. But most of the states, yes, I'll be pressing on it.
Okay, that's excellent. That's excellent. All right. Well, we've been on for close to an hour. So I see we had a good amount of people join, watching. That's what they do. But just so you guys know, this is going to be up. Sean and I are going to do this every week. You also may want to check out the podcast. Sean and I will connect on that if he wants to just hop on a podcast and talk to that audience as well. Our information is in the description. If you want to reach Sean, his name, his website, his contact information is in the link below. So definitely click it. But for the sake of being audio, do you want to repeat it back to them, Sean, on how they can reach you?
Yes, you can always call me on my cell. It's area code 702-809-9401, or email me at Sean R. That's SEANR at Barrett, BARRETT financial.com.
Excellent. Well, I want to say thank you so much for joining. I'm excited that we're doing this every week.
Yes.
Yeah, I'm mad excited. And then I'm gonna pull back more because this is more for, like I told you guys before, this is more mortgage, and I'll chime in when it comes to credit. But you guys feel free to ask questions. Even if you're watching this after the live and you have questions, just put it in the comments and we'll answer your questions. If not, right then and there within the next episode. But every Sunday at 5, if we need to change the time, we'll let y'all know. But 5 Pacific Standard Time. All right. But in the meantime, I wish you guys all the best of luck on your credit journey. You guys have a good one. Take care.
Take care, guys.